What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is October 20th of 2020. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, we have an extremely critical topic to discuss today, a very historic moment, whether it be for good or for bad, where the International Monetary Fund, or the IMF, one of the most powerful organizations across the globe, has come out claiming that they're seeking out a new Bretton Woods moment. Now, I know a lot of you out there probably couldn't give two cares about what a central bank has to say or what a major an organization like the IMF has to say, because a lot of you guys don't like central banks or these powerful organizations. But along with that as well, it's important to not only listen to what they're saying so we can understand how it's going to affect Bitcoin, but also how it's going to affect the global economy. This announcement has major ramifications of the course of what's going to happen here over the next few months through the IMF, and also what's going to happen throughout the global economy. So we have to understand this, and we're going to be diving into this not only in today's video, but also through a sponsored interview with Mauricio from Ledin.io later on in the video, where we get a lot of great insights from Mauricio, who actually comes from Venezuela himself. So without further ado, let's go ahead and dive straight into this. It's one you're not going to want to miss, guys. Let's go ahead and talk about this. So again, a lot of people at face value might not know what the International Monetary Fund is, and along with that as well, what Bretton Woods is. So I not only recommend you guys go out there and do your own due diligence and learn a little bit about those two things, maybe before the video or afterwards. But to give you a brief summary here, the IMF is the International Monetary Fund. It is one of the largest financial bodies across the globe, or financial organizations or entities. It is a conglomeration of a wide range of countries from across the globe, from developed to developing countries. And basically, the goal of the IMF is to focus on debt restructuring, to basically help countries who have been burdened by debt in this case, and basically giving them a refinancing on their debt through the IMF's debt in this case, and then being able to basically clean off the balance sheet of these countries and go through something known as structural readjustments, basically forced or mandated changes for these countries to undergo. And a lot of people, again, as many of you have probably learned about, if you're really big on learning about monetary policy, learning about these powerful organizations, I know some of you will have positive and negative opinions on the IMF's actions. I'm not really here to talk about that today. If you guys want my honest take, I think they've been relatively negative, whether intentional or not. It tends to be that central planning doesn't always work as intended, but I digress. That's not the point here today. What we need to talk about is taking it a step further and understanding why it's critical that a new Bretton Woods moment is going to meet some dramatic changes on the global stage when it comes to positioning yourself in different types of assets, but also what's going to happen in the sense of the global economy, and why the IMF is calling for this right now. So taking a step back in history, for those who may not know, Bretton Woods was a major moment post-World War II where a large group of countries came together, called on not only building a new monetary system, a new monetary structure for a post-war environment, but also trying to look forward into the future about what we wanted to seek out in the sense of collaboration and building a global economy post-World War II in a much more collaborative and open free market. And this basically changed the course of history. This one meeting was extremely important in actually determining the fate of the future, again, whether for positive or negative. So again, it's not about our opinions here. It's just understanding that this is going to be a critical moment here. And when the IMF comes out, when the head of the IMF here, who's Kristalina Georgieva, there's a few different pronunciations. I've heard her last name, but she's a Bulgarian head of the IMF who has replaced Christine Lagarde. She's gone off to the ECB. And this has now built a really, really interesting narrative here that we are going to be seeking out some really interesting changes. And as they kind of mentioned here in the bullet point here, this is focused obviously on a post-COVID world where we have gone in through one of the greatest recessions, if not depressions, since the 1920s, worse than 2008 on the global stage, where emerging markets are extremely weakened now due to a failure of response monetary policy. And we're going to hit on that point here in just a moment, because that's really what the IMF is after. And along with that as well, they mentioned things like climate change and just the general change of the global economy. There's been rapid change even without COVID. And this is going to be setting the stage here for the IMF to make a dramatic response here. So first off, again, I recommend you go watch the video from Kristalina, I apologize. You should go read and listen what she has to say to get a general idea, because it kind of backs up what I'm going to be talking about here in today's video. So let's just go ahead. If you just want the clean-cut answer here, the IMF specializes in focusing in emerging or developing economies. These are countries that probably predominate in Latin America, in Southeast Asia, are countries that are industrializing, that don't really have a full-scale formed middle class. Again, the income levels and general poverty standards are going to be different than what you're going to see in mostly Western countries or developed countries such as the US and Canada and China and Europe, a lot of different regions across the globe that are probably much more established. So the IMF is dealing with dozens of countries across the globe trying to help in debt restructuring. So what's been going on since COVID here that really has established a divergence here that the IMF is concerned about, a problem that has called for this new Bretton Woods moment? Well, what we've had with COVID is a total stunt in the global economy, a total freeze on activity in the economy. And this has basically created a massive incentive for central banks to step in and do something about it. There was a big liquidity crisis, as we saw. The dollar shot up in value because, again, the world needed dollars, whether you're not in the United States or in other countries. So much like the euro, the Canadian dollar, and the Japanese yen, and a lot of other major currencies across the globe, the central banks got to printing, especially the Federal Reserve. And the Federal Reserve printed more money than it ever had in history in a singular month or singular year. We've created about anywhere from 20 to 24% of the total existing monetary supply this year alone, just to signify that importance. And what's really nice actually is, whether you want to debate, again, if printing is good or bad, overall, this has actually been a pretty effective step of monetary policy from the Fed. This is what the Fed is meant for, whether you like it or not. They're meant to print money during these times. And the same goes for the ECB and all these other organizations to basically, again, push capital into the system, keep the system flowing, and get money into the hands of businesses, as well as different types of expenditures throughout the economy. But I digress. Again, it's not a debate here whether or not it's good or bad. It's just talking about what happened here. And what's interesting is that, again, whereas we probably take the position that, the U.S. is doing terrible, other developed countries are doing terrible, that this response is not really getting money into the hands of people, I would agree with that. But the interesting thing is that you would expect this kind of printing, 20+% increases in currency in one single year to cause mass hyperinflation, to cause all these major issues. And really, it's not really the bad end of the stick here, guys. What's been really bad is the lack of response in emerging economies. Emerging economy central banks and governments that manage monetary policy are not responding the same way these countries are responding. In fact, they have had a lack of printing. So not only have they been going through the damages of a post-COVID environment here, or maybe they're currently going through COVID in a larger wave, and the damage repercussions of that, but along with that, they've really left the lockdown to just persist. They haven't been providing major stimulus. They haven't been providing this kind of monetary relief. Some people say that's good, but at the end of the day, it's been pretty disastrous in this case. It's been terrible for these economies because we've had a forceful shutdown of the government and the economy in a lot of these regions without the monetary help. And the entire banking sector is teetering on absolute insolvency here. It's just not getting reported much in this sense because a lot of it gets brushed under the rug. And you'll hear more about this from our conversation with Mauricio, who can kind of speak to this coming from that region of the world. And there's a reason why they're not printing here, because the United States and the ECB and all the other major central banks that have major world reserve currencies alongside the dollar, they have a benefit here. And that is that they have global demand for their currency, especially the United States being the world reserve currency. So let's go ahead and just do a thought experiment here. Let's go ahead and take a look at the US dollar comparative to other currencies in developing regions, predominantly just as a great example throughout Latin America. We've got the US dollar to the Argentinian peso. So as this is going up, this means you can buy more Argentinian pesos with your dollar over time. This means that the Argentinian peso is losing value to the dollar, or the dollar is gaining value to the Argentinian peso. You can see it either way. So you've got the USD, ARS, the Argentinian peso. How about we take a look at the Brazilian real here? Again, we're looking at a monthly chart here. So you're seeing over the course of multiple years, but you can also get a picture of the relative past here over 2020. Take a look at the Brazilian real here. Take a look at the trend here. Let's go ahead and take a look at the Mexican peso here, right? The US dollar against Mexican peso. And then again, another steady uptrend here. The US dollar to the Colombian peso here over the last few years. Along with this as well, the US dollar to the Peruvian sol, another major currency in Latin America. And also, of course, the Venezuelan bolivar, which I can't even get real market data for because it's gotten so bad through the black market for Venezuela, right? So you can see here, all these charts are already vertical. Right? They're already struggling to keep up with the dollar here. So why would it be that the Latin American countries or the countries and emerging economies are not responding as fast as, say, the Federal Reserve is with printing new US dollars? Well, the reason for this, guys, just simply put, to give you the clean-cut answer, is because that they're not only dealing with the difficulty of trying to keep their currency against the dollar, but the moment one of these central banks, one of these governments or countries go about printing more money, basically it's going to give an absolute opportunity for people to short and bet against the currency and possibly set these currencies up for a real case of Venezuela-styled hyperinflation. That's the concern here. Again, these currencies are already teetering on the brink of failing. The entire currency and banking system of a lot of these countries is not that sustainable. And we don't really know the full picture because a lot of these countries are basically in a showdown. They've got their guns out, they've got their revolvers out, they're looking at one another, and they're curious about, where are these countries at, right? They're like, how solvent are these countries? Which one of these countries is going to enact printing of money first and second, right? They're trying to see who's going to take the step first and if they're going to do it in unison. And along with that as well, the problem here is that the United States, as I mentioned before, has an added benefit. There are people outside of our country, a set of global demand, who want US dollars. That is not the case for Argentina or Brazil or Mexico or any of the countries that we listed. It's a different dichotomy. So when you don't have that world reserve status, it's a very, very tricky situation. And these countries need to respond differently. There's another reason as well. They usually be able to print money, but the reason why is because of their balance sheets. They are not solvent as countries. They have massive debts that need to be paid back. And this is where the IMF steps in. So how does this all come into play, right? So the IMF is saying, look, we need to restructure these debts. This is a major problem. We need to get these countries back into a state of solvency if we are to hopefully keep ourselves from really going into the global depression that in many cases we might have avoided to some degree in some areas, because this will affect developed economies as well. So there's an incentive to hopefully fix these problems early on. And this is where I truly believe, and I'm curious as well to hear what you all think, I truly believe this is why the IMF here, just the other day, just a couple days after this Bretton Woods announcement, is coming out discussing cross-border payments, building a revolutionary, visionary future for cross-border payments. And this is something that we've talked about with Alex Saunders before from Nuggets News. This is something from Brent Johnson, who's been talking about the dollar milkshake theory. And it basically has to do with building new liquidity channels for the global economy, being able to get capital across the globe. This is basically, I think, the IMF's way of saying, hey, look, if you're not going to work with us directly, a lot of these countries are hesitant to work with the IMF in a lot of ways because of structural readjustments, of all these policy issues. They're going to be injecting liquidity themselves, and it's not going to be in the native currencies of the world. It could very well be in dollars. It could be very well in euros. It could be in different currencies. This is where there's going to be a very big challenge or kind of teetering between the IMF and the central banks of the world and competing with one another. Again, they don't all work together, guys. They basically tolerate one another if you want to know how it generally works. Commercial banks, they don't like each other. Central banks, same exact thing. They all have different they don't have aligned interests. They have different incentive structures to compete against one another. So just taking that into account here, what I think we're seeing is a leveraged play of the IMF and some of the major banks across the globe. And what's really interesting here is that at the end of the day, this is going to have major ramifications for the printing of new money, new forms of stimulus into the economy, and overall is going to be a really, really interesting, not only conversation, again, for good or for bad, but a change to the global economy. Now, we had a video, obviously, as I mentioned yesterday. It was about an hour-long event where, again, we had the head of the IMF talking with major leaders from the BIS, like Augustine, and along with that as well, people like Jerome Powell from the Fed, and a lot of central bank leaders coming out and talking about digital payment networks or electronic payment networks that are working towards central bank digital currencies or CBDCs, which have been, again, talked about since 2015. It's just getting real now. So we really could see a massive change in the traditional banking sector. We could see a massive new system built that is going to allow for the injection of capital directly into people's pockets, or money more specifically. The important thing here is cross-border payments, getting money into emerging economies as dollarization, or the demand for dollars in these countries, has grown larger and larger. And again, you can read into this here. Jay Powell has, again, kind of seen more than anything, has been seeing these CBDCs as a complement, in this case, to the overall financial system. And again, they're currently researching it. They want to make sure they do it right. And again, this has been something that I know we've been hearing a lot about. I think ever since Libra, central banks have finally had to come out and actually take this serious and or admit that they're researching into this and that they've got plans for this. And the Fed, more than anything, wants to get the dollar out to as many people as possible. They want to get the dollars demand to as many hands as possible because they have the printing press. It gives them control as an organization to have more weight over the global economy and their views on monetary policy. So all in all, guys, now that we've taken that into account here, I know it's the moment you're waiting for. What does this mean for Bitcoin as an asset? I'm going to be honest in telling you guys, quite frankly, I've got a few ideas, but I don't know exactly what this is going to mean. You know, at the end of the day, CBDCs are still very vague, and as I mentioned here towards the tail end of the video, we don't know when they're going to be implemented. We don't know how quick central banks are going to step up and really actually implement some form of CBDCs. China was really the first major country to do it. They've had some pretty great success so far, as it's a direct way to bring stimulus into people's hands, whether they're banked or unbanked through a mobile application. But I digress. The major point I want to share here that I at least see out of this is that it's going to be overwhelmingly positive for Bitcoin. Yes, I know I'm giving the bullish case scenario, and the reason why is because any new channels like this that are going to lead towards the deliberate delivery of capital, whether it is to financial markets, like we've seen with the Fed's move here. Really, a lot of the money has just been going to financial markets and not into the hands of everyday people, right? Whether it be that, or whether it be a central bank digital currency for retail consumers that is deliberately delivered to their mobile phone and they go spend it at different types of stores, whatever it may be, neither way, you are creating mass amounts of money. You are building a new liquidity funnel that is most likely going to incentivize central banks to print trillions of dollars over the next year or two. And this is going to be dramatically beneficial for assets like Bitcoin, for assets like gold and silver. And quite frankly, I think it's going to be beneficial for stocks, properties, just about any other asset in the world. But as time progresses and that funny money stops, you're going to start to see the tail end of the benefit go towards hedged assets like Bitcoin, like Ethereum, and other digital assets, as well as gold and silver. So I think that is the incredible narrative we have here. We have all that's going on here with the IMF. We already have the craziness with central banks across the globe. And now we've got all these companies, for example, like Square, like MicroStrategy, kind of being the early warning signs that companies are getting ready. Their corporate treasuries are getting ready to position themselves in a very changing time when it comes to financial and monetary policy. So anyways, guys, that's it for me in the sense of this kind of base discussion. But I want to go ahead and dive into this sponsored interview with Mauricio, where we continue the conversation and also dive a little bit into the Ledn platform. But again, I want to remind you all, please leave a comment down below as to what you think about this. Let's get a conversation going. Again, let's not think with our opinions on things. Let's talk about what we think this means for the global stage. That's the most important thing when you're investing. All right, so let's go ahead and dive into the sponsored interview. Alrighty, everyone. So in today's sponsored interview, I'm sitting down with my good friend Mauricio, who's one of the co-founders of Ledn.io. place where you can not only earn interest on your digital assets, but along with that as well, put your crypto to work and get more exposure to the market for large cryptocurrencies like Bitcoin. Mauricio, thank you so much for making the time, man. It's always a pleasure to have you. And can't wait to just chat today. We've got a lot of stuff to discuss. We're not only going to be diving into the platform, but also be, as per usual, talking about our macro topics and the things that we're watching and kind of pick from each other's brains on what we're watching at the moment.
Yeah, very excited to be here. It's like, as always, it's very action-packed week. So excited to kind of, talk about everything that happened. And it's everything that's upcoming, really, with the new IMF moves. I think there's a lot of moving pieces in the next few months. And always happy to showcase our new stuff here. So I'm excited about the show today.
Absolutely, man. Yeah, I can't wait to dive into those conversations about the IMF. I think you've got a good perspective, kind of seeing the differences between developed and emerging economies as the IMF really deals in emerging economies. So before we dive into those conversations, I recommend you all stay tuned for it's really exciting topic. I want to go ahead and actually spend some time to do something we haven't done in a while, which is actually dive in directly to the Lending platforms. It's usually just Mauricio and I talking, but today we're going to be spending some time diving into the B2X program, and what better man himself to do it than Mauricio himself. So I'm really curious, Mauricio, if you want to spend some time to dive through, what is the process like? Because I know since I first used Lending, you guys have really improved the user experience along the ways you guys have been growing.
Yeah, so that's something that we're very passionate about, is just keeping the platform super simple and super transparent. It's part of our DNA. So what I wanted to do today was essentially to spend a minute to showcase what the Lending dashboard looks like for a person that is registered and signed into an account. And I'll do a quick showcase of the savings account. And then I just wanted to spend a minute to essentially take out a B2X loan and repay that, just to show how quickly that can be done and how simple it is.
Awesome, man. Yeah, I think the cool thing is everything is kind of synonymous within the platform. You can access all your key services on the left-hand side. And it's like, if you want to first get the savings account, that's the first thing you would natively do on the platform. And once the crypto is on there, then you can go to accessing those B2X services within the platform.
Yeah, exactly. So the home base at Lending are your two savings accounts. So we have a Bitcoin savings account where you're earning 6.5% APY annually, and the USDC savings account through which you earn 11.7 APY annually. So what I can do now is just what you're seeing in your screen now is the Lending dashboard. So this is essentially what summarizes your Bitcoin savings account, your USDC savings account, any B2X loans that you may have, and your dollar loans. Just quickly to show what a Bitcoin savings account looks like, when I click here on the page, essentially it takes me to the summary. And in here, you see all of my transaction details. So every time I've sent money to it or withdrawn money from it, or every time I've gotten an interest payment, it'll all be shown here. And in essence, if you just want to send funds to the savings account, you just click on deposit. It'll pull your address, which you can copy or use the QR code, and then you can send funds to your Lending savings account. To withdraw, pretty simple as well. You just click on the modal and it pops up the amount and the address, and then you can request the withdrawal. But in essence, once you already have the Bitcoin in the savings account, like I do in this one, using the B2X service is very simple. It just takes a few clicks. So I wanted to essentially just demo that really quickly. Here's my B2X page. You see here that I actually have an existing loan, but instead what I'm going to do now is take out a new loan and then show what a loan repayment looks like. In the B2X page, there's a calculator for a new order. So in this case, in here, I will show how much Bitcoin I want to use in the service. So right now I'm placing half a Bitcoin. And what this says here is that Lending is going to purchase another half a Bitcoin on my behalf, and I'm going to end up with one full Bitcoin as collateral for my B2X. For that additional purchase, I'm going to take out a loan of $6,000.96. And this is based on the price of Bitcoin and basically the fees associated with the loan. But once I've decided the amount, I click on place B2X order. And in here, I get to essentially read my terms and conditions so I can accept them. And then I have to input my authenticator. So 1 second.
One of the things that's always, it can be a bit tedious, but at the same time is definitely necessary if you want to be putting a large amount in any crypto platform for sure.
Yeah, so this is an irreversible transaction. So that's why we request the authentication. But once it's inputted, you can see how quickly it gets done. And now essentially my B2X loan has been successfully opened. And here I'm just going to do a quick refresh so that you can see my B2X loan. So in here, you can see this is the recent loan that I just took. It has 1 Bitcoin in collateral, and the outstanding amount is 6,060 cents. If I go back to my Bitcoin savings account, I see that it took out half a Bitcoin as I instructed in my my B2X instruction page. And then once the loans are active, then they just show up here in your active loan tab in your B2X page. And you can essentially send additional collateral to any one of the loans if you'd like to bring your LTV down. And when you're ready to repay them, all you have to do is click on repay. You can choose to repay with the Bitcoin that is currently in collateral for that loan. So that's the quickest and fastest way to do it. Once you select it, we give you a quote that is time logged for 1:30. And essentially we give you the details of the repayment. I can select whether I want the delta of that Bitcoin to be sent to my external hardware wallet or back to my Lead and savings account. So in this case, I'm going to choose to get it sent back to my Lead and savings account. And lastly, to close once again, then it just asks me for my authenticator, which I will put here. Excellent. So now my repayment has been confirmed. I see my success message that my loan close request was successfully submitted. And then if I refresh the page, then I'll be able to see my Bitcoin back in my savings account, and essentially my B2X loan has been closed.
Awesome.
And that's it for the demo. That's how quickly you can get in and out of a B2X.
I like it, man, because what you basically done, Mauricio, is obviously you guys have the way to earn interest on crypto, which alone to me is like, that's my favorite because I'm more of a hodler. But, someone like, an average everyday person who might have Bitcoin might want to take that extra risk exposure. And what the B2X program pretty much does is it makes probably one of the simplest ways to get like a 2x exposure to Bitcoin, or to basically take out a 2x margin position in this case for crypto. And I think it's phenomenal. And the cool thing is that you can do this with other assets down the line. I know if you guys decide to list Ethereum and other cryptos, but you've kept it simple. You focused on Bitcoin, the biggest market. You offer the dollar savings account, which I think is phenomenal. And I mean, you guys obviously are still maintaining some of the highest rates in the market. So I'm really proud of the work you guys have been doing.
Thanks, I appreciate it. And really, I think one of the biggest game changers or edges that B2X has, it's really the cost of the borrow. So right now it's an all-in 14% for a year. If you try to do a similar operation in another exchange, you're looking to pay upwards of 25% plus annual. Wow. for that position.
Wow, that's incredible, man. I mean, really, congrats to you guys on doing that. I know you guys have been working with Genesis and a lot of institutional companies to get those rates at the best possible level for the borrowing side and also for the depositor. So again, kind of pressing that margin as thin as possible and stuff, and hopefully reaching as large of an audience as possible. Mauricio, thank you, friend, for just taking the time to dive into it. Love the new user experience. I think what's nice about this is it feels like it's like I'm actually interacting with a whole suite of like different applications. You made your referrals there, borrowing the standard borrowing program as well. If you want to take out like a dollar stablecoin loan in that case, so very, very cool. I appreciate you taking some time to share that.
Thanks. No, it's my pleasure. We work very hard, so it's always exciting to get the showcase.
Awesome, man. So I guess if you're ready for it, man, I'm interested to dive into some of this conversation that we were talking about having, above all in regards to what's going on with the IMF. So we just had the IMF having one of their annual meetings, and one of the new heads of the IMF actually basically not only called upon basically all the partner countries across the globe to come together and kind of have a new Bretton Woods moment. As we've been going through this pandemic and the world stage, we've been having massive amounts of unemployment. GDP is expected to fall a few single-digit points this year alone, which is something that we haven't seen. It's worse than 2008. And along with this as well, we have a lot of people, especially, I think, as you know, Mauricio, in emerging markets who are really feeling the pain of this, whether due to their country being exposed to dollarization or just the lack of being able to get access to any hedge during this time when there's been, no response in this case from the banking sector. So I'm curious just here, what are your thoughts on, man? What's this talk about digital currencies and everything going on?
It's a great question, and I think what the statement that was put out last Thursday by the IMF is seemed to have gone a little bit under the radar, and I think most likely that's because a lot of people don't quite grasp the implications of what that means. The Bretton Woods Agreement is obviously very popular within the Bitcoin community because it essentially was the last time that the global currency system was backed buy a commodity or hard asset, in this case, gold. For those that don't remember, the Bretton Woods Agreement was done in 1944 by the Allied countries after World War II. And the agreement said that the participating central banks were going to hold fixed exchange rates between their currencies and the dollar. And the dollar was at the center or the backbone of the schema because it was backed by gold at the time. So it was essentially like this chain of value that had a buck stop at the dollar. We moved very far away from that since. And what the IMF director said essentially last Thursday is that we are now staring at a second Bretton Woods moment. What that means is a few things, at least in my view. In the statement, she very well pointed out that major central banks have expanded balance sheets to the tune of 7.5 trillion. To put that into context, the stimulus package is being proposed by the Republicans and the Democrats just now is touting $2 billion in addition to that. All this to say that all this stimulus has actually been carried out by the major central banks, the large economies. You haven't heard about a blockbuster stimulus deal in India or Brazil or Iran. They just haven't happened. So what the IMF is saying is, guys, the only reason the US is still, keeping recessions and all these things ashore is because of all the stimulus that was printed aggressively given to them. So US people were able to meet their debt obligations and essentially even put some money away or to protect themselves for potentially even harder times ahead. Mm-hmm. The countries that haven't printed stimulus are basically staring at a full default of their retail banking system because people don't have jobs and they don't have money to pay back their debts. So who's suffering right now is these retail banks in emerging countries, which are basically decapitalized entirely because of the defaults. Now, what is the IMF proposing? The IMF is saying emerging economies need to print. It's necessary that they print, otherwise their banking system goes down. And if their banking system goes down, all the clients from those banks go down too, which are companies and people. So when people talk about the banking system going down, they really mean the economy is going to come to a stop. So what the IMF is saying is this can't happen. And some of these countries basically haven't wanted to print because they know that the second they do that, they're just going to cause hyperinflation because their balance sheets are so weak right now to expand. So what is the IMF saying? How do we fix this, essentially? Well, the proposal, I got caught for a second. The proposal that the IMF has put out, in short, is saying that they want to create an aggressive debt restructuring and debt forgiveness plan for emerging economies. If they are able to pull this off, what they're trying to do is remove liabilities from the balance sheet of these countries so that they can then print with a lower risk of causing hyperinflation. Mm-hmm. So in doing so, they will save their banking system and address some of the hyperinflation concerns. So I'll pause there because I'd love to get your opinion. But that's kind of what I've taken away from it so far.
Yeah, Marisa, I think we talked about it a bit before. I think for me personally, I've heard a lot of different ideas, but I think as you mentioned earlier, a lot of people don't understand what the IMF is, what the International Monetary Fund really does. And the IMF, whether it's a good or bad organization, I think those of us who have researched, we have our opinions on it. The IMF's supposed goal and what they really do, similar to how central banks manage interest rates and the printing of money, is the IMF is focused on basically debt reduction programs. And they usually do this through coming to a country like Argentina or Brazil, and for example, if they're in a crisis, or could it be someone in Southeast Asia, for example, they've done it in the Philippines and Thailand. And basically, usually due to mismanagement of the government in some sense, or large investment programs, so they borrowed a lot of debt and they can't repay it due to the interest rate, there will be structural readjustments and they'll take the bad debt off their balance sheet, similar to a central bank, and basically have another form of debt that's refinanced at a lower interest rate. So that's the general kind of goal of the IMF. And from your explanation, Mauricio, I think this is very true because what it considers is why these countries aren't printing. I think that's the question. There would be no disincentive why they wouldn't, unless they were afraid of literally doing enough printing to where it destroys their system. And it's kind of a game of, I think a good way to view it is kind of It's not a game of musical chairs. It's more like a showdown. Everyone's got their guns out and like, which one of you is printing first? Are we going to print together? And no one's too certain because the banks and the countries don't have vested interest 24/7.
100%. And if you look at the countries that have like, I'm not going to say rush to the printer, but the guys that have been like, oh yeah, to set up aggressive stimulus, no worries, are reserve currencies. Because to them, the fear of inflation is non-existent. Like even in the States today, sure, print 2.2 trillion. Like basically what they're saying, they're calling the bluff on everyone else that's not printing, because they're saying, okay, like if we have to print, I don't even want to imagine how much those guys are going to have to print. So I think right now there's a bit of a gap because everyone's looked at how aggressive the US has been on their stimulus, and you look at those other countries and they haven't had to do it. Now,
Yeah.
there is no universe where the world's strongest economy printed stimulus and the world's weakest economies didn't have to. It's essentially they're basically shoving some things under the rug, which is what's concerning the IMF, because they're saying, okay, guys, like you're not printing, but you're not giving us the full picture either. Like I'm sure your poverty must be through the roof. I'm sure like depression must be through the roof. I'm sure there's like very low resources to carry out any social programs. So what the IMF is really saying is, guys, like let's come clean because this isn't the game anymore.
This is going to be bad. And here's the thing too, Marie says, like, the IMF has, as you mentioned, since Bretton Woods, been made up of a lot of developed countries as well. And to think for a second that this won't come back to bite us in the butt, due to export demand declining, all kinds of different kind of domino effects that will spin out of control if we don't help these countries, or at least do something to collaborate and see how we can resolve this together in a smart and transparent manner, then it's going to be bad news for a lot of these countries and eventually a lot of the developed countries. I think, the point you brought up there in that case, again, we've usually seen a lot of these countries over the last few years be willing to print massively, like in Argentina. We've already had some cases of depreciation in currencies or hyperinflation, but the benefit that the US has having the world reserve currency, and this is something that I think I've had the fortunate privilege of seeing as I travel, is just really how much demand there is for dollars across the world. And really, the thing is that this printing of money, a lot of people go shouting to the roof and saying, oh my God, the Fed's going to hyperinflate the currency. We created over 24% of the existing currency supply this year in 2020, not even a full year since March. And the crazy thing is that may not be enough. It may not be enough because there is so much demand outside of the US, which is one of the strongest economies in the world, but outside of that in other parts of the world. So it's this interesting dynamic. It's not me just being pro-US or anything, but you can see, Marie, so it's like there's so much demand in different corners. Whereas if you take the Argentinian peso, or you take, for example, the Filipino peso or another currency of the world, they don't have that same demand being the number one currency that people use to price things and store wealth.
You're 100% correct. In my view, it's an absolute huge privilege to have. And we've been following is the bank earnings. So U.S. bank earnings. The U.S. banks, major U.S. banks reported last week, and we've been basically following their guidance and looking at the reports to see essentially what they are seeing in the future. The interesting thing about that is that so they are not seeing the losses start mounting like they expected. There are no delinquencies like they expected. So they've built up these massive reserves in Q2 and Q3 for loan delinquencies and loan losses. And they're basically waiting for them. They see them as this looming thing that delinquencies are coming. It's not really that the stimulus got rid of them, it's that the stimulus pushed them further ahead, right? And why they're saying that, which I thought was fascinating, is that essentially they're seeing, okay, they're looking at consumer spending patterns. So consumer spending patterns in the US are largely back to normal, albeit with some discrepancies on some
certain consumer maybe things they would do in a pre-COVID world. Yeah.
So essentially they've shifted more shopping for clothing and basically not spent as much on travel, but the overall amount is the same. And so basically the banks are looking at this and saying, okay, well, spending is the same. The debts are still there. It's not like they've gotten all repaid, and unemployment still way below pre-COVID levels. So what they're saying is, it doesn't really look like people are putting away a fund to essentially repay these delinquencies further out. They're just using the stimulus money and spending it, right, to at least meet their obligations. So what they're saying is, In their guidance, very elegantly, they said, we see stimulus being very difficult beyond 2020. Obviously, that's bank speak for it's very hard to pass stimulus when you're not in an election year, which makes a lot of sense. So they're actually projecting the losses to start 2021 when the political will to continue passing stimulus has kind of eroded, which I thought was fascinating. And they're actually seeing what they're projecting is for delinquencies in loans in the US to peak at the end of 2021. So I thought that was fascinating. So wanted to share that.
To see that delayed kind of symptom, and again, keeping in mind, I think the great thing you've done, Mauricio, in the sense of picking up what these either central banks or organizations like the IMF are doing, is they're thinking about those big kind of events on the world stage. They have to view things in a very macro perspective, and they do certain actions. When we talk about launching central bank digital currencies, when we talk about these major programs by the IMF, it takes a lot to get these countries to come together and do things, let alone one single country or central bank. And to have these kind of policies that are wide reaching and strategizing how you're going to go about it. Again, we can talk about whether it's good or bad that, we have these central banks doing the things they're doing stuff, but it really is, it's the way things are right now. And it's going to have dramatic impacts like we saw with how central banks responded back in March to the stimulus in the US and Canada and the EU, UK. So I'm just very, very interested to see how things continue to go over the next few months. But we're going to have to see, man. It's an exciting time for sure. And above all, Mauricio, I always appreciate you taking the time to chat, go over not only a little bit about Ledden and stuff, because I think you guys have built a great platform. Congrats on all the growth you've had. But along with that as well, just getting a picture of what's going on, man. I mean, this is the perfect time right now. Again, it's why we built Digifox. It's like focusing right now on like getting a way to get yields, getting a way to get access to digital assets. Like this is what it's all about right now, man. So hats off to you guys. And just as always, it's great to chat with you.
Likewise, Nick, it's always a pleasure. And I can't wait to be back soon to share more updates.
Absolutely, Mauricio. Thanks so much for making the time, man.
Thank you.